Hello, everyone. Welcome to another Financial Fridays with Saini's and Equitable. Today's topic is Investments 101, and Saini's very excited to offer these sessions in cooperation with our corporate partner, Equitable Advisors. Joining us today from Equitable is Luke. Thanks for being here, Luke. And just a reminder to everyone, this session is being recorded. We will save questions until the end of the presentation, but feel free to add questions to the chat or use the Q&A feature at any time, and our presenter will get to you. And please remember to keep the questions general, but the Equitable team is available to answer any questions you have. You can find their contact information for your regional rep at sanis.org. And I will turn it over to you, Lee.
Thanks, Paige. Hi, everyone. Happy Friday. I hope the school year finished well for everyone. What we're going to go through today is what we call an investing 101. So this is a newer one. This is only second time we've done this one for the Financial Fridays. And it's when we started because a lot of questions came up around investing. And I think at the end of the day, or at the end of this presentation, you're not going to be Warren Buffett ready to day trade, but you will have a good foundation of how investments work, especially within retirement accounts. Now, just something to start with there. We're doing some Tier 6 changes webinars. One is going to be on July 15th. This is the QR code if you want to register. I'll give everyone a second if they want to take a picture and register. Again, that's for a Tier 6 changes webinar next Wednesday. So, in the world of investing, there's really three major asset classes and two sub-asset classes. So, the first asset class is cash. Now, traditionally, people don't really think of cash as an investment, but technically it is, and by definition, it's any riskless investment. So if you think like checking, savings, money market, CDs, you're never going to go to your savings account and it's going to go down unless you took money out. But it's also never going to earn a whole lot. So cash investments historically average between about 0 and 3%, but really inflation averages about 3 and a quarter. So if I'm only in cash investments, I'm actually losing out to inflation over time. So in order to beat inflation, we have to take on a little bit of risk. Now, we still want cash investments because we still need to pay our bills and need an emergency reserve, but we just don't want to have too much in cash because we want to make sure we're outpacing inflation over time. So the first way that we can outpace inflation is through bonds. Bonds are effectively an IOU from a company or government. So to explain that a little bit further, think about going to the bank and taking a mortgage out. Does the bank make money on your mortgage? Yes, of course. Otherwise, they wouldn't do it. How do they make money? You take a $200,000 mortgage out, they charge you interest, you pay them back with interest over time, which is how they make money. Bond is the same exact idea. If the state of New York wants to build a new highway, well, they can pay for that in cash, but they're likely going to pay for that in bonds. It's going to cost them $1 million and they issue 1,000 bonds worth $1,000 each. If I buy that bond from the state of New York, well, then I am then lending them my $1,000, but they're going to pay me back with interest over time. So it's the exact same idea as a loan, except now we're the bank instead of the person taking the loan. Bonds can be issued by a variety of different organizations. So you can have government bonds. This would be like US government bonds. You can have municipal bonds. So this would be like my state of New York example. You can have corporate bonds. So this would be like Apple, Amazon, Google issuing bonds. International organizations would be any organization outside the United States, international governments, international businesses, and then high yield bonds would be like if smaller organizations issued bonds. And bonds can range in a variety of lengths. You can have 1 year bonds up to 30-year bonds, and they can even go longer than that. Same idea as a loan. You can have a 1 year loan all the way up to a 30-year loan. Generally speaking, the larger the institution and the shorter term the bond is, the lower risk, but the lower return. So the US government is really the largest issuer of bonds in the world. And if I have a 1 year US government bond, I am going to have much lower risk and much lower return than if I have a long-term high yield bond. Now, still, when we say investing, we find a lot of people's minds still don't go to the stock market. They really go to or they don't go to the bond market. They really go to the stock market. Stocks go up and down every single Monday through Friday. Somebody invested in the market is taking on the greatest amount of risk, but is going to see the greatest amount of return. The way we think about the market is first by size of the company. So we have large, medium, and small cap companies. So cap stands for capitalization. It's effectively the worth of the company. Large cap companies are worth over $50 billion in value. These are companies that most people are going to be familiar with. Companies like Apple, Amazon, Google, Coca-Cola, Disney. Mid-sized companies or medium cap, they're going to be from about 5 to 50 billion. Many of these people still be familiar with, many of them they will not be. It's going to be companies like Royal Caribbean, Delta Airlines, Dick's Sporting Goods. They're big, they're just not quite the size of your Apples and your Amazons. Then we have small cap companies. So small cap companies are going to be from about half a billion to 5 billion. This would be like your Harley Davidsons, your Papa Johns, your Corning Glasses. They're big companies. They're much bigger than your local mom and pop shops, but obviously Harley's not quite affecting people's daily lives like Amazon is. International companies are companies just domiciled outside the United States. So Nestle, Samsung, Toyota, and then emerging markets is investing in growing economies around the world or companies within growing economies. So big ones right now would be India and Brazil. So if you think the United States, well, we're well past our industrial level revolution. These countries are really just going through theirs, and their companies are really up and coming. So it's buying into companies within those growing economies. We then have growth and value-oriented companies. So growth-oriented companies are companies that are researching, they're innovating, they're developing, they're trying to get larger in size. They're reinvesting their profits within themselves. So Amazon's a great example. Amazon turns a profit every single quarter and year. When they turn that profit, they reinvest it in themselves so they can innovate. That's how they put new warehouses literally like every square mile. That's how they come up with new fleets of trucks. If you look at an Amazon truck, it looks completely different today than it does 2 years ago. That's because of research and development. They're research and developing how can we make our trucks more efficient. Whereas our value companies are typically going to be a little bit older of companies. They're not really looking to grow as rapidly. Coca-Cola would be a really good example of this. Coca-Cola has been around for over 100 years. They obviously turn a profit, but instead of just continuously reinvesting in themselves, they pay dividends out to their investors. So they still want people to buy their stocks. So they incentivize folks more through dividends or cash to their investors than through appreciation in their stock price. So typically speaking, your growth companies are a little bit more volatile. They have more ups and downs. Your value companies are a little bit more your steady eddies. At the end of the day, you're buying Coca-Cola. You really know what you're getting with when you're buying Coca-Cola. When you're buying a new tech company, there's a lot of uncertainty there. Then the two sub-asset classes would be real estate and real assets. So real estate would be not necessarily buying a house, fixing it up, and renting it out, but something called a real estate investment trust, which is similar to like a mutual fund for real estate. And then real assets would be like gold, silver, commodities, any physical, tangible asset. So they're very real assets out there. Not a huge part in retirement accounts, but they definitely can be within retirement accounts. So terms you might often hear when you're talking to folks about investing are things like risk tolerance and aggressive, moderate, conservative, moderately aggressive. So I just want to talk a little bit about what that means. So here we have three different pie charts. And what does it mean to be aggressive with your investments? What does it mean to be moderate with your investments or conservative with your investments? Somebody that's aggressive with their risk tolerance means they're mostly in the stock market, about 90+% in the stock market. Somebody that's more moderate is going to be about 60% in the stock market, 40% between bonds and cash. And then someone that's maybe moderately aggressive would be in between there, like 75% the stock market, 25% elsewhere. Then conservative would go down even further conservative. Somebody might be 20% in the stock market. One of the biggest mistakes we see all folks make with the risk tolerance, especially public employees that have a New York State pension, is people are always so worried about being too risky for too long. The reality is, the way bigger risk and the way bigger mistake people make is they get too conservative too quickly. You are way more likely to fail in retirement by becoming too conservative and staying too aggressive. 100% stock portfolio, which I'm not saying someone should be 100% stock portfolio in retirement, but 100% stock portfolio in retirement is more likely to make it than a 40% stock portfolio. So always want to be mindful of, are you scaling back your risk too early, or what exactly is happening there? The other thing we see people make the mistake of is someone will ask them, like, oh, what risk tolerance do you want to be? I want to be moderate. And they don't really know what that means. And all of a sudden they're 20 years out and they're already a moderate investor. So they're just giving up a ton of growth on their investments. Now, when it comes to, okay, so you have all these different investment classes, but how do you actually pick what's the right one? How do you know? So there's a process. The first step in that process is there's something called an efficiency frontier. So basically, what the efficiency frontier says is there should be a certain amount of return for any given level of risk. There should be a relationship between risk and return. So if we look at this x-axis, this is the risk. The farther right we are on, the more risk we're taking on. The y-axis is the return. The higher up we are on the y-axis, the more return we're getting. And the blue bar represents, the blue line represents the efficiency frontier. To be fully efficient, we have to be on that blue line. So if we have this red dot, this is a hypothetical portfolio. You can see it's not working fully efficiently. It's taking on the risk of a moderate plus investor, but only really getting the return of a conservative plus investor. And there could be a variety of things that's happening. Maybe somebody's 100% in small cap growth, or 80% small cap growth companies and 20% in cash. That means they're moderately aggressive based on my last slide, 75, 25, 80, 20. They're moderately aggressive. But is that really the most efficient way to be a moderately aggressive investor? No, not necessarily. So we always want to make sure we're getting the right amount of return for our given level of risk. The mistake so many folks make when they look at investing is or picking investments is they just look at the return. They just look at the historical return. They don't understand necessarily how much risk they're taking on to get that return. So step two in that is looking at, okay, if we're not fully efficient, or to be fully efficient, where are we amongst the market? So in an inefficient portfolio, maybe we're just not properly diversified. Maybe we're really heavily weighted in areas we should be, or underweighted in areas we should be in. Maybe someone just looked at all the mutual funds available within their 403b and 401k and said, hey, this one did the best last year. Let's put all our money in that one. When the reality is we want to be properly diversified. We want to have areas touching on all the different parts of the market and want to have the correct weights, not just looking at where the market was, but where the market's going. Because again, how do most people pick their investments? They look at how it historically did. Well, over the last 20 years, only once has the best performing asset class been the best performing asset class twice in a row. So we want to make sure that we're not just looking historically, but we're looking in the future there. And then with that, something that I think is often missed within not just the financial industry, but every industry, when it comes to investments, just like every other industry, companies have their niche where they do really, really well. There are over 1,000 companies that issue mutual funds and ETFs. Not 1,000 mutual funds and ETFs, 1,000 companies that issue them. And they all have their spot where they do the best. So I'll use large cap growth as an example. So this is an area that T. Rowe Price, Vanguard, and Fidelity do a really, really good job in. And those are three of the largest mutual fund managers in the world. But what happens because of that, you get companies like PIMCO that say, well, we don't want to compete with Fidelity, Vanguard, and T. Rowe Price because they're really large, they're really good in that space. So we're going to invest all of our dollars into bonds. And that's why PIMCO has become the best core bond money manager in the world, or mutual fund manager. Every single day, people will say to Kelly and I, no, I'm all in Fidelity, or I'm all in X company, or I'm all in Y company. And it's like the reality is every company does better in different spaces. You just want to make sure you're going out and using different companies for different things because no one company is the best in every single space of the market. And then it's just about repeating that process. Just like financial planning as a whole, an investment portfolio today is not going to be the most efficient investment portfolio forever. Things have to be reviewed, looking at things and saying, okay, am I still taking on the most efficient amount of risk versus return? Or there's things that have become more efficient for us? Every day we talk to folks and they say, I haven't reviewed my account in 4, 5, 3, 10 years, whatever it might be. And there's just no way an account that was set up 10 years ago could be the most efficient today. Think about how much has happened in the last 10 years. You got COVID, you got 2022, you got a lot that happened in that time. So is it maybe our risk tolerance as a whole change? Maybe we are moving a little bit closer to retirement. Have to go from aggressive to moderately aggressive. Or maybe we have had things that have done really well and outgrown other areas and general rebalancing needs to happen. Or large cap growth and tech did really, really well, but now it's looking like large cap value might do a little bit better. And then in step three, is it that just certain money managers have started to perform better than others? T. Rowe Price, I use that example because they literally were the best large cap growth mutual fund manager for like 40 years. And then Vanguard and Fidelity exploded onto the scene. And is it, hey, the money manager there was doing well, but they retired. We think X, Y, and Z company is going to do better. Or there's other sectors that are looking better than others. So it's just a continuous process to keep somebody on that most efficient risk versus return frontier. Because if I just set up an account and I forget about it for 10 years, it might grow, but there's no way it would grow the most efficiently as it could potentially. And then a little bit of switching gears. So I'm going to switch gears from investments to taxes. Because another thing we find is they are two completely separate things. And what I mean by that, the type of account doesn't necessarily determine the investments within the account. It determines the taxes associated with that account. So you have your pre-tax investment accounts. This would be money that goes in, you get a tax deduction for contributing. It grows tax deferred, so you don't pay any taxes on the money as it grows. Then you go to take money out in retirement. That is when you'll then pay the taxes on. So that would be 403(b)s, 457s, or deferred comps, and traditional IRAs. So you get a tax deduction for contributing. You don't pay any taxes on the growth. You take money out in retirement, you'll then pay the taxes on that money. Then you have post-tax investments, and this breaks out into a couple different categories. So you have what are considered fully taxable accounts. With these types of accounts, pretty much they're taxed at every single step of the way. So the money that's going in already has been taxed. So if you put money in your checking, it's already been taxed through your paycheck. You don't get any growth on your checking account, but if you did, you would have to pay taxes on the growth. Now, you don't pay taxes when it comes out because you've already paid taxes on the money that you put in and the money that grew. But if you held like an individual stock, when you sold the stock, you then pay taxes on the growth. Then you have tax deferred accounts. These are not very common type of accounts. They're very unique tax code. Money in these accounts goes in on an after-tax basis. You do get tax deferral on the growth, but you're going to pay taxes again on the withdrawals. And then there are your tax exempt accounts, which this would largely be your Roth accounts, so your Roth IRAs, your Roth 403(b)s, your Roth 457s. In these type of accounts, money goes in on an after-tax basis, so you already pay taxes on the money that's going in. As the money grows, you don't pay any taxes on it, and then you take money out in retirement. It's completely tax-free. So a question that we'll commonly get is, well, which one's going to return better? The pre-tax one or the Roth one? And realistically, the actual growth on the investments should be the same because they have really the same investments available to them. Now, does that mean if someone should use pre-tax or should use Roth? That's a completely separate tax conversation. And you should talk to somebody about that because we find a lot of people will say, I heard Roth is really, really good, and it is phenomenal. Doesn't mean it's the right fit for everyone. But there's a lot of misconception around which type of account is going to grow more from the investments. They should have the same investments, but then they're just different tax codes. Hi, Kelly, anything you want to add?
Everyone ready to trade with Warren Buffett? I assume so. If you ever want to quit your day job, stock market's usually open. So
Does anyone have any questions? Hopefully, you do feel like you're ready to day trade with Warren Buffett.
I think one point just to as Luke finishes up here to keep in mind is like the world of investments and investing is kind of like the universe. Like once you get to Pluto of understanding, you realize there's infinite universes. There's never going to be the mecca where it's like, I understand everything there is to know about investing. I've got it. I'm good. Like that is not that's not how the world works. It's just like education in that sense, in the sense of like, oh, I just know everything there is to know about educate. Like, no, like it's a constant evolving how we manage and look at money today, how we did it 5 years ago, how we'll do it 5 years from now are all very different mediums because things are always changing. The tax code is always changing, investments and how investments work are always changing. So it's one of those things. This is never a set it and forget it. It's a dynamic, ever moving um, medium. So that is an important part of things. And that's important related to your own investing and investments of like, you've got to understand what's going on. The base level understanding is always the same. But then from there, it's okay, what's changing and how is it impacting me? And it might not be at all, and it might be significantly, but it's something that needs really regular revisiting to making sure that you're on pace and things that you set up and were in good order for a few years ago doesn't mean that they're the same now.